this is part 2 of the California Property and Casualty exam. This is my mind map, which is available if you'd like for $3 or so. I'll put the link up later. But first, we look and see the distribution of the subject matter, the percentage of questions that are asked. I went over this earlier, and this time I wanted to cover some of the insurance basics. It's part of the 31% of the test questions. So right here you can see that really this encompasses property basics, liability basics, and insurance basics. So from here we'll go on to the next part of the map. I click here and it takes us over to the next. Now I'll zoom back a bit so you get an idea. Quite a subject matter, and this is just a basic portion. So I can zoom out and get an idea of the size of it. So this would be the mind map portion of it for the whole, for just the insurance basics. And then we would do liability basics and property basics. Okay, so let's start. I would start from who. So we have the two parties involved. It would be the insured and the insurer. So going to the insured, the rights and duties. And you should prompt notice of the loss and damages. You should take care of the stuff that's damaged, just not leave it there. You must submit the claim, notify the police if there's a theft, and cooperate with the insurance company. That sounds nice. Here are the important clauses. The Abandonment Clause, and this prohibits abandoning partially damaged property to the insurer. You don't want to just leave it to them. And there's a Mortgage Clause, and they'll always get paid first if there's a mortgage on the property. This Loss Payable Clause is the same idea. And then you have a Cosign Clause. The Cosign Clause means that you should have sufficient insurance to cover the value of the property or the liability. So if you underinsure, then if there's a partial damage, they may also pay an under payout. So the amount of insurance carried, 80%. So the equation is the amount of the insurance carried, that's what you presently carry, divided by 80% of the new value of whatever its assessed value, times the amount of the loss, and that's how much they would pay out. If you take your claim and you find that you're within the top 20% still, as far as the value between the actual and value and the insured value, then you're okay. Okay, and then there's a question of vacant, and that terms means there's no contents, there's nobody occupied. Unoccupied, the furniture looks like somebody's still living there, but you can't find anybody around. Okay, and the insurer, you have rights and duties. So they paid for the covered losses. That's what they're supposed to do. And they provide legal defense when you have a claim filed against you, liability claim, and they have to give you advance notice of cancellation and return unused premium if it's canceled before the premium period. And then important clauses for them. A surrogation clause. This means that if they step in your shoes to sue a third party, that they have had to cover your loss. So if you're in an accident, let's say, caused by another, then they pay you out, but they reserve the right to go after and sue the person actually caused the harm. This also has the result so that you don't try to collect twice, once from the insurance company and then go sue the person that ran into you. Liberation clause means if there's a general broadening or an addition of endorsements or some sort of advantage added, that if they didn't charge any increase in premiums on one group of people, they can't do it on the other. Other insurance clauses: what is to be done in the case of other contracts covering the same property? You got several contracts covering the same issues. Who's first? And then finally, salvage. The insurer has the right, after paying for the loss, to see what can be done with the salvage. All right, so that takes us over to what? Here are some definitions. Loss, I think that's self-explanatory. Exposure, well, it depends how the hazard is exposed, or what the exposure is to a probable danger. That will determine the premium. Proximate cause is important. It's really the original cause of the loss, or the effective cause. And the claim is the demand made by the insurer, of course. And the word indemnify means to make whole. So that's what an insurance company is supposed to do over a covered risk. It's generally a real general definition of insurance. It's a social device for reducing or transferring risk. And then you have an insurable event, whether past or future, may indemnify a person having an insurable interest. So it could be that you're harmed. You took something now that harms you later, but it's still covered. Something happened to you, but the actual events like whiplash or something didn't come out till later on. And then the insuring agreement. We'll go over the structure of a policy. But the insurance agreement is it states which perils are the hazards, the different things, the possibilities of what could cause loss, and their location in the period of the contract. That's called the insuring clause. We'll go over that more here in just a minute. So now I'm going to come up over to here, and we're going to talk about the actual types of contracts. And so here we have the anatomy of a contract. So you have to have an agreement between two people. I think that's clear. You have to have legal purpose. You can't have a contract dealing with a crack house. And consideration is what's going one way and the other. The insured promises to pay the premium, and the insurer promises to pay for the covered loss. And you have to have competency. You need a working brain. So that's clear enough. Up here, we'll come up here to now the actual, as I told you before, insurance policy structure. This is how that contract is formed. Starts out with a declaration. That's the who, what, when, where, how much the premium, and the period of the term. And here's that insuring clause. You see I have this green connecting arrow. It states the perils against the person and or property and their location and the period of the contract. So, and then you have definitions, which is clear enough, and then exclusions. And these would be the perils or the dangers that are specifically excluded. And then you have the endorsements, and they would be added on as extra benefits, if you might, or extra coverage. And then we have the condition. The condition contains the manner in which both parties would treat each other. Here's a liberalization clause. That means if they offer a wider coverage and they don't charge one group and increase the premium, they can't charge you. You're not supposed to have, conceal or do fraud in your application or in the treatment of the liability or property, and it'll give the policy period and the territory. So that is the construction of the contract of a insurance policy. Well, now we went over the anatomy, the elements of a contract, and insurance types of contract. So let's see what kind of contracts they are. This one's called that is an insurance contract between the insurer and and the insured is an aleatory contract. So aleatory means, imagine some kind of scale that a little bit on one side would cause the other scale to go up very high. So this means that the payoffs wouldn't necessarily be the same. So you could have a relatively low premium, have a huge loss, and they would have a lot of money to pay off. So that's the tip of the balance. Adhesion is kind of like take it or leave it. They say this is the premiums we'll charge you, and this is what we'll cover, and if you take it or leave it. So you're kind of either take it or you leave it. And so when it comes to something that's not specific or specified in the contract, when it comes to suing the actual insurance company, the courts will favor the person that had to adhere, because the burden of proof would be on proving that something shouldn't be covered, even though it wasn't stated, is against the insured. And the conditional contract. Now, you have a conditional contract. We have two bi-conditional or uniconditional. So the conditions must be met by both parties before the contract is legally enforceable. Conditions for both the insurer and the insured are spelled out in the policy form, right? They're in that conditions part. And then we have a personal contract. Now, what that means is that if you get an insurance policy, that policy is not necessarily transferable to somebody else. There are some like life insurances that transfer over to the wife's or husband, whichever it might be. And then we have the unilateral contract, one way. Only one of the party to the contract, that be the insurer, makes an enforceable promise. He promises to pay if something happens. So it's a unilateral contract. And it's all of these depend on utmost good faith, that nobody's lying. Contract requires that each party is entitled to rely upon the representation of the other without attempts to conceal or deceive. So there's a question there whether one tried to deceive the insurance company, or the insurance company not paying the proper amount on the claims, or finding a way of delaying, which is a tactic. I have another video called the top 10 worst insurance companies. If you'd like to check that out, then go ahead and visit my other, subscribe, and you can see my other links. Alright, now how about the actual business and the type of insurances that you're going to get, and type of insurers. Almost anybody can be. I mean, if you have enough money and enough set aside monies, I suppose you could open up your own insurance company. So the one that we call is a stock insurance company, where the stock owners own this insurance company, and they elect a director, a board of directors, and officers to run it. And they get dividends, and they're taxable. It's probably like just buying stock. You buy stock in a company, and you're a part owner, and you get dividends, and you receive dividends, and if you make money on the dividends, you pay tax. Now, this is a mutual insurance company, which I belong to one of these for life insurance, and this is actually owned by the policy, not the stockholders, but the policy holders. And they choose a board of trustees or director to run it. And profits are returned to the policy holders as a non-taxable dividend. So you can see that's nice. And it's non-assessed, meaning they cannot charge pro rata losses. So if there's a loss, then you're not required to pay off the loss. So there you have it. Then we have fraternal benefit societies. So you can see that's maybe like a fraternity or some get together and they decide to make an insurance company. Now, these reciprocal insurance companies, they're an aggregation of individual firms and businesses that are under the same type of business, each member is known as a subscriber. The exchange of insurance is effected through an attorney-in-fact, and each subscriber assumes a part of the loss, or part of the risk of all other subscribers. If a premium collected are insufficient, then an assessment of additional premiums can be made. Risk retention group. This is a group owned insurers who assumes and spreads the liability risk of its members. They are an actual insurance company. And then we have Lloyd's of London, risk from other insurance companies. They're based out of England, so you have these rich people, group of high net worth individuals who share the risk of the insured. Each group, individually known as a syndicate, are responsible for the amount of insurance they write and different classifications of risk that they write out directly. I remember a case where they insured a satellite. That type of risk was directly written off of Lloyd's of London, and the satellite got wrecked or deviated from its orbit, so it was pretty much a loss. And they had enough clout and power and money to hire NASA to go up there and try to put it back online. And that was one of the satellite rescue deals paid by Lloyd's of London. That's interesting. And now, types of insurance. Well, you have personal or commercial. This is within the property and casualty framework. And over here, looks like you have casualty, which would be like liability. Liability is a loss caused by injury to a person, damage to the property of others. That would be a liability to you. And property insurance indemnifies a person with an interest in physical property for its loss or loss of its income producing. So that would be if you had some physical property producing income, then in that case you could have property indemnifies a person with an interest in physical property for its loss or the loss of the income producing ability. We have property policies, casualty policies, and then we have the package policy. In the personal side, you have like dwelling, which would be the property where one lives. And then you have casualty. This is cover your liability, not so much of your car, but of any damage you cause with your car. So that would be individual property and casualty policies. In the commercial, you would have, like dwelling, you'd have commercial property, and you had flood, earthquake, inland marine, that's like for trucks, ocean marine, that would be transportation of freight. Then, with regards to liability, you have general liability. Somebody gets hurt in your business, and this would be if a commercial vehicle being driven. Workman's comp is something that's for every worker that works. You need to have them covered in case they get hurt, and you can have against crime. Professional liability. This could be something to do with like omissions and errors sort of thing, where you forget to or you consult somebody to give the wrong advice. And then you have excess liability. So now these are packages where they're put together. A homeowner's package will actually be putting liability of somebody getting hurt on your property together, like with fire and we'll see other perils that are covered. So that's a package. You have one for personal watercraft, would be covering the property and if someone gets hurt. Specialty vehicles, I suppose you could say like a motorcycle or some other thing that doesn't have four wheels. And you have a personal umbrella, which sits on top of all of your existing insurances to increase the amount of liability coverage and cover gaps that you might have. In the commercial, you would have a commercial package, which will combine the commercial property with the general liability. And for the smaller business owner, you have the same sort of thing. It's basically also that and general liability. And then for the machinery, a company with a lot of machinery, then you would have, again, a package that would cover this this on the commercial property and the general liability side in one package. Now, let's talk about some property insurance principles. You have losses, and you have the hazards that cause the losses. Let's talk about perils. Well, perils are many. Fire, theft, rain, etc. Named perils. They're when they're actually stated. If you remember in the Insuring Clause, perils specifically covered on the property insured. Open perils means if it's not, this is the best really, because it's saying if they don't say what it is, if they don't name it, then it's covered unless they specifically exclude it. And concurrent causation, where they have two or more perils work together concurrently to cause a loss. And then you have direct consequence of a particular peril, which is a direct loss. And you have consequential, like a fire would cause some other thing to go wrong in the house, and say set off the sprinklers or something like that, which would be a consequential loss to the direct loss. And you have what's called a loss reserve. This is the funds that a company is required by law to set aside to cover claims, so they can't reinvest the money. They have to, well, they can, but they have to keep a reserve. It's like in the banks, and when you bank, the bank can lend out money, but they have to keep a certain amount of reserve for people that come in and want to withdraw money from the account. So there's something called a loss ratio. If you take the losses plus the reserves and add them together and divide by the earned premiums, you would get that ratio. And down here you have an expense ratio, where you take the total operating expenses and you divide it by the total premium. That makes sense. Now, what are the hazards? Physical hazards. Any hazard arising from the material structure or operational feature of the risk itself. Moral hazard. Moral hazards are habits that increase the probability of loss from a peril. So, moral hazard could be just in way one's habit is of treating particular hazards. And then we have the moral hazard, when somebody thinks, well, I'm insured, so what the hell? So you have this insured's indifferent to loss because of existing insurance. And you have a legal hazard, where likelihood of a loss will occur because of a court action. So that takes us to that part. Now, let's talk about the marketing aspect of it. You have your independent agent, and that person will enter into an agent agreement with one or more insured. Exclusive, a person under agreement represents a single insurer or a group of insurers having common owners. And a direct writer is an insurer that deals directly with the insured through a salaried representative or a captive agent, as opposed to an insurer that contracts with the agent. This would be someone salaried representative or a paid agent, and that as opposed to an insurer that contracts an agent. So you would be, as an independent agent, you would be contracted. And direct mail, this is like having insurance companies having the online version of, or a place for them to sell directly, and they don't need an agent at all. It's coming off of the internet. And a broker, okay, so the broker is a person who actually works a benefit for the person coming in the door, and it can transact other than life insurance, but it's not on the behalf of the insurance company. He would go to several places to work for it. So you could have a broker may not charge a policy fee, only the insurer can charge that. So the insurance broker, I think of it something like travel agency in the old days. They still have them, but you go in and then they work for you to try to get to flights. And then you have an insurance solicitor salesman. Now, this insurance salesman who who contacts potential customers. So he's like, I like to think of him like sort of cold calling. And he'll handle clerical responsibilities but has no authority to make insurance contracts. In real estate, you have the broker, and the salesman actually hang their license under the broker, so they really have no authority to make a contract without their license being under a broker or representing that broker. And then you have managing general agents. Now, my understanding is they don't use them much anymore, but it used to be like when they opened a new branch from the East Coast to West Coast, it was too far, and the distances then made it difficult so somebody had to make decisions on the spot as though they were the manager of the whole insurance company. And nowadays they seem to be focusing on what's called surplus insurance market, and we'll be going over that soon. So we've covered quite a bit. You can see that there's a lot of different. Now if you see a little plus sign here and you click it, so you can see there's actually a lot more to be done. So I'll split this into the next section and we'll pick it up from this actual business model. Okay, subscribe, and if you like this format of showing the topics as far as the mind map is concerned, you'll see the link so that you can purchase one for $3. You have $3, but here you go.